The more money that you have, the easier it becomes to hide that and avoid taxes. Wisely observed by Jeffrey Hollander. Ever wondered how some of the wealthiest folks manage to pay less in taxes, like Warren Buffett pays a lower federal income tax rate than his secretary? You will be revealed to that secret soon. Welcome to Finspiration. Today we're diving deep into the world of taxes. Get ready to uncover the 7 easy steps rich people use to legally dodge the taxman and keep their fortunes intact. But first, here's a jaw-dropping fact from ProPublica. Between 2014 and 2018, the 25 richest Americans saw their wealth grow by a staggering $401 billion. Impressive, right? Well, what's mind-blowing is that their income tax payments during that period only covered a measly 3.4% of that new wealth. Yeah, you heard that correctly. Now, before you think about breaking any laws, let me clarify, we're talking about tax avoidance, not evasion. Tax avoidance is as legal as your grandma's apple pie recipe, and these tax tricks aren't exclusive to billionaires. It's something you can use too. These tax tricks aren't just for the elite. You can put them to work for your financial benefit. So, are you ready to transform your tax game and keep more of your hard-earned cash? Well, let's get started. Number 1. Invest in municipal bonds. When it comes to sidestepping taxes like a pro, the first move on the checklist is investing in municipal bonds. Now, don't let the term scare you off. Municipal bonds are essentially like lending money to your friendly neighborhood government, whether it's a state or local entity. In return, you get interest payments at regular intervals, just like a steady cash flow. But here's where it gets exciting. The interest you will earn from these bonds. It's like a magical money shelter because it's exempt from federal taxes. And guess what? Depending on where you live, you might even escape state and local taxes. Municipal bonds historically have lower default rates than their corporate counterparts. From 1970 to 2019, a mere 0.1% default rate for investment-grade municipal bonds versus a whopping 2.25% for global corporate issuers. Now, here's the twist. Municipal bonds often have lower interest rates compared to other options, but don't let that fool you. It's all about the tax benefits. The higher your tax bracket, the higher your tax equivalent yield. So, if you're in the mood for some tax-saving magic, step into the world of municipal bonds. Number 2. Tax-free unrealized capital gains. Now, let's get into the second jaw-dropping tactic rich folks employ to keep their tax bills down. You see, most billionaires don't rely on a steady stream of income like the rest of us. Their wealth is wrapped up in stocks, real estate, and other assets. That's called unrealized capital gains. In the land of U.S. tax law, you don't pay a single cent in taxes on those investment gains until you decide to cash in, regardless of how much your portfolio has ballooned. This nifty strategy lets you defer taxes on your winning investments in your brokerage account until you're ready to pocket the profits. So, while you watch your investments soar in value, the taxman is kept at bay. Now, here's the kicker. It's not just for the elite. You too can embrace the magic of unrealized capital gains. Number 3. The whole life insurance twist. When you think of life insurance, you probably picture it as a safety net for your loved ones if you were to meet an untimely demise. But guess what? The wealthy have found a way to turn this mundane insurance policy into a financial powerhouse. Here's the kicker. You, the policy owner, get to enjoy these tax benefits during your lifetime. But wait, there's more. After your journey on this planet comes to an end, the policy benefit doesn't just vanish into thin air. Nope, it goes directly to your chosen beneficiary. And guess what? They get it tax-free. But hold your horses. This isn't a one-size-fits-all strategy. Before you dive headfirst into the world of whole life insurance, it's essential to consult with a seasoned financial planner or insurance expert. They'll help you determine if this is the right move for you. Keep in mind that not everyone sings praises about whole life insurance, mainly because of those pesky expensive fees. Now, let's move on to the simplest and easy step. Number 4. Family business advantage. Now, picture this, you're a savvy business owner and you've turned your venture into a family affair. No, we're not talking about those awkward Thanksgiving dinners. We're talking about a clever tax-saving strategy. Hiring your own kids to work in your business can be a game changer. Here's the scoop from the IRS. If your child is under 18 and working for you in your sole proprietorship or partnership, you won't have to shell out Social Security and Medicare taxes. Yep, you heard it right, no extra taxes. But it gets even sweeter. Your kid's income won't be taxed at all unless it climbs higher than the standard deduction, which for the tax year 2023 is a cool $13,850. That's a pretty hefty chunk of change they can earn tax-free. Now, here's the best part. You can actually deduct your kids' wages as a legitimate business expense. Instead of watching your hard-earned dollars vanish into the tax abyss, you can transfer some of your business income to your child as wages for their services. It's all perfectly legal as long as the work is legit and the salary is reasonable. So, why pay high taxes on your business income when you can put your kids to work and keep more of that money in your pocket? It's a win-win situation, folks. Now, let's make a splash into the 5th legal step in our tax avoidance journey. Number 5. Buying a yacht or second home. Alright, let's be honest, most of us can't just snap our fingers and buy a yacht or a fancy second home. But for the wealthy, these aren't just lavish purchases, they're clever tax strategies. If you own a home and itemize your deductions on your tax return, you can usually deduct property taxes and mortgage interest. There's a cap of $10,000 for property tax deductions, but if you add a second home into the mix, guess what? You can deduct taxes and mortgage interest on that property too. The IRS considers a yacht as a potential second home, but before you start fantasizing about life on the high seas, there are some conditions. Your yacht needs to have sleeping quarters, a kitchen, and yes, even a toilet. That's how you can deduct the taxes and mortgage interest on that property as well. It's a bit impractical for most of us, especially if you're not in the market for a floating mansion. So, whether you're dreaming of a yacht or just trying to spruce up your home sweet home, there are ways to navigate the tax system to your advantage. Now, let's dive into the 6th genius move that the savvy and tax-savvy use to their advantage. Number 6. Tax-free health savings accounts. These little financial gems were originally designed to tackle healthcare expenses, but guess what? When wielded correctly, they become a triple tax-free powerhouse. First off, contributions to an HSA are tax deductible. And here's the kicker, you don't even need to itemize deductions. That's right, it's a tax break that's open to everyone. Any earnings in your HSA grow tax-free. Your money is out there, working for you, and the taxman stays far away from your gains. But that's not all. If you use the money for qualifying healthcare expenses, those distributions are tax-free too. Just remember, if you decide to use your HSA cash for non-healthcare expenses, you'll typically face a 20% penalty. Once you hit the ripe age of 65, you can withdraw your HSA money for any purpose without penalty. However, you'll still owe a bit of that ordinary income tax if you decide to splurge on non-health related expenses. So, it's a win-win. To join this club, you'll need to be a part of a high-deductible medical insurance plan. So, choose your insurance wisely, my friends. And remember, contributions have their limits. In the year 2023, you can squirrel away up to $3,850 for individuals or $7,750 if you've got family coverage. So go ahead, open that HSA, make those contributions, and watch your tax bill shrink while your savings grow. Now, let's dive headfirst into the 7th legal step to avoid taxes. Number 7. How charitable deductions reduce taxes. So, you might wonder how Warren Buffett, the Oracle of Omaha, manages to pay a lower tax rate than his secretary. Well, here's the scoop. He donates billions of dollars worth of Berkshire Hathaway stock to charity every year. And guess what? He's entitled to claim some of these donations on his taxes. You heard it right, the savvy move effectively slashes his taxable income in half. While we might not all have a charitable deduction that rivals half our income, for those of us who itemize our deductions, there's a sweet opportunity to get a nice break for our generosity. You are helping a cause you're passionate about while reducing your tax bill. So tell me, what's your favorite charity, and could you see yourself taking advantage of this strategy? And there you have it, folks. The secrets of the wealthy are unveiled and show you the world of legal tax-saving strategies. And now it's your turn to take the wheel. Remember, these aren't secrets reserved for the elite. Anyone can harness these techniques to make the most of their hard-earned money while staying well within the bounds of the law. Before we sign off, don't forget to hit that like button if you found this video as mind-blowing as we did. And if you want to stay on top of all things personal finance, make sure to subscribe to our channel and ring that notification bell so you never miss an eye-opening episode. Now, tell us in the comments, which of these tax-saving strategies are you most excited to try out, and what would you do with the extra cash you save? We can't wait to hear your thoughts. Until next time,